Fund Supermart, your online gateway to unit trusts.
Judging from the strong market trends in Q1, investors were generally enthusiastic about the outlook for global economies and markets. What is your opinion?
Well, clearly the markets are driven by hope right now. They hope that after years of central banks being the primary support of financial markets, that budget spending, the promises of infrastructure spending, of tax cuts by the new administration in the US could be a new driver for growth going forward. In our opinion, we will have to wait and see. We have seen actually in the recent weeks that it seems much more complicated for the new administration in the US to implement what they wanted, even though they dominate the government, the parliament, and they have the president. So only time will tell how much of these pro-growth policies are going to be implemented. At the same time, we remain concerned because the fundamental issues, the fundamental structural problems of the US economy, of the global economy, are not tackled yet. So these cyclical pro-growth policies are attractive. They could definitely help, but they are not a solution to the structural problems of this world.
Looking beyond the market trends, geopolitical concerns are looming among investors. Do you think investors should wait, or is there any opportunities out there?
Well, one thing is sure, patience is always good. As a long-term investor, being patient is clearly a key feature that helps to be able to take advantage of rising volatility. At the same time, I would also say that waiting for the world to look good and that all the problems are gone, you will wait forever. I think that the structural problems, the structural risks, macroeconomic, social, geopolitical risks are here to stay. They may get worse, they may get better, but hoping for a world where you don't have any risks to make any investments, you'll probably wait forever. So the key element is really try to find a balance between patience and between being able and being willing to invest, to deploy cash when you're able to identify attractive investment opportunities. Of course, it's more complicated today, but this is where patience is, especially today, quite important. But every moment where you might have a bit of volatility, even if there are risks, these are the moments that you should take advantage of price volatility to find attractively valued opportunities and to buy them at the right price.
How do you find value in these challenging markets?
That's a challenging question. We definitely are in a high-risk, low-return world. So it has become, for us value investors looking for margin of safety for cheap and good companies, it has been increasingly complicated over the past 12 months to find such opportunities, especially with the volatility, which is now at 30-year record lows. But if you just look over the past 2 years, there have been windows of moments of distress. Because of China, because of energy. And at some point in the next few months, we will hopefully have another window of distress. And at that moment, we will be ready to deploy cash in what we think are scarce, difficult to duplicate businesses that have a resilient behavior and that are trading attractive valuations. So right now, we're spending a lot of time on research, on preparing our wish list, on having the cash ready to deploy, and always monitoring, even on an individual company basis, if we're not able to find here and there some opportunities.
Is value investing still viable when market changes so often? Do you think holding for long term a challenge? And has this shortened your investment horizon?
Well, markets tend to always fluctuate. And as value investor, fluctuations, volatility is not our enemy. It really is our friend. Our enemy is losing money. It's not volatility. Permanent capital loss is our enemy. Volatility is actually a source of margin of safety, especially over the short term. In terms of investment horizon, actually, the current market environment has made us even more long-term in a sense. Because volatility is actually lower today than it's been historically. And as a result, we tend to own companies a bit longer, and it usually takes more time for us to buy them because of the lower volatility profile. So maybe in a world where others have become more short-term driven, we have become even longer-term investors due to the evolution of the market. In average, we hold companies now for around 10 years. If you look, for example, at our portfolio turnover ratio, which is around 10% right now, that basically means that we own companies for around 10 years in average.
We noticed that your portfolio has energy holdings when this sector is one that has been affected by the recent development of the markets. What are the values that you see in them?
Now, as value investors, we typically don't buy the sexy, the trendy, the beautiful stocks because they are very expensive. This is the companies we are selling because they're expensive. As value investors, if you want to identify good companies that are cheap, you typically have to focus on the out-of-favor areas of the market. Benjamin Graham, the father of value investing, always said that you have to focus on the unwanted, the unloved, and the ugly. Energy is definitely an area that has been unwanted, unloved, and quite ugly over the past 2 years, with the oil prices dropped from 125 to at a low point of 25 last year. This negative sentiment, this out-of-favor trend, has provided us with a certain number of opportunities. Not necessarily actually with companies that are very sensitive to the oil price. We own companies that produce pumps, that produce engines that you use to pump oil and gas. These companies often have a huge aftermarket business. Most of their earnings doesn't come from selling pumps or from selling the engines. It's from maintenance, from repair. And it is typically a lock-in situation where the cash flow is highly protected and not quite, actually very independent from the oil price. So they were affected because they looked like oil and gas, but their cash flow structure is actually much more resilient and able to endure even very low prices in oil and gas. So these are the type of companies, dominant, scarce, very hard to duplicate assets, and a very resilient profile that we've been able to identify in this out-of-favor market and to buy at very attractive valuations.